Warren Buffett, who's likely to be the most talked about investor on YouTube and probably all over the internet, and to be honest, the world, is most famous for achieving one of the best investment returns in recorded history. According to AQR, Buffett's returns have been so good that if you could travel back in time and pick one stock in 1976, Berkshire would be your pick. In fact, $10,000 invested in Berkshire stock in 1980 would have compounded to more than $23.5 million today, realizing a compounded annual rate of return of over 19%. Myriad of investors have attempted to replicate the Buffett magic in the search for riches. Some have failed, and some have done pretty well, at least in the short term. But how can one exactly attempt to replicate Buffett's portfolio in the future and for long periods of time? The answer may be easier on paper and harder to stick to in real life. Systematic investing is an investment strategy whereby investors forego any discretion in order to build portfolios that are rules-based, transparent, and hopefully simple. Portfolios that a computer could run without any human wisdom or insight. So, the question we'll attempt to answer today is there any way to systematize a Warren Buffett portfolio? In other words, is there any way to invest like Buffett without being Buffett? Because let's be honest, most of us are likely not as smart as the Oracle of Omaha. Now, this question is far from original, and thankfully, it's been long answered for us. In the 2017 paper, Buffett's Alpha, AQR's Andrea Frazzini, David Kabiller, and Lasse Pedersen attempt to first explain where Buffett's alpha comes from and then replicate a Buffett portfolio to test their findings. They conclude that Warren Buffett's Berkshire Hathaway has realized a Sharpe ratio of 0.79 with significant alpha to traditional risk factors. The alpha became insignificant, however, when we controlled for exposure to the factors betting against beta and quality minus junk. Furthermore, we estimate that Buffett's leverage is about 1.7 to 1 on average. In order to understand this statement, one must know that alpha can represent manager skill or luck, or it could also be exposure to an untested or unknown factor. In this case, by running a regression analysis, the authors find that Buffett's exposure can be explained by a handful of risk factors. And these factors are the market factor, as Buffett invested mainly in stocks, the value factor, as Buffett preferred cheap stocks, the low volatility factor, as Buffett targets safer stocks, and the quality factor, as Buffett is known for investing in profitable, high-quality firms. Loadings to these factors are all statistically significant and reduce Buffett's alpha to being relatively insignificant both at the firm level and at the public stock portfolio level. It's also important to mention that Buffett also levered these returns up to 1.7 times equity by tapping into Berkshire's debt and insurance float, or simply put, money and reserves for claims, by tax shielding from accelerated depreciation, and by writing derivatives without the need of posting collateral. This too explains Berkshire's higher volatility as compared to the market. Frazzini, Kabiller, and Pedersen then backtest a factor portfolio adjusted for Berkshire's beta and idiosyncratic volatility to find that a replicated Buffett portfolio actually would have beat Berkshire's actual performance over that period. Now, the authors go on to clarify that this replicated portfolio does not account for trading costs and other factors that would make this an apples-to-apples comparison. More importantly, though, this paper does not and should not take away from Buffett's accomplishment as an investor. After all, these papers explaining his performance are thanks to Buffett's identification and targeting of these risk factors before the academic literature could even catch up to him. Still, the one question to ask is, are these returns achievable by the average investor, at least pre-leverage? I asked this to Alpha Architect CIO Wes Gray. Here's what he had to say.
Warren Buffett's returns can certainly be almost achieved. However, there's two components of his returns. There's the leverage component, which would be challenging for everyday investors to capture because Warren Buffett's generally considered to be levered from $1 to $1.6 to $1.7. Most investors don't have access to that leverage or can't do so in an efficient way. However, the second part of what Warren Buffett does is essentially buying cheap, high quality securities. And of course, there's many algorithms to include the quantitative value algorithm, but also other available options where folks can buy factor funds that are low cost, tax efficient, and cheap that deliver on these factors that Warren Buffett is achieving, which is again, value, cheapness, and some argue some element of safety in the form of lower beta securities.
From the 30th of June of 1998 to the 29th of February of 2000, Berkshire lost 44% of its market value, while the overall stock market was gaining 32%. This is a reminder from the AQR paper warning against any and all investors attempting to replicate Buffett's formula, or any other formula that has the potential to beat the market over the long term. Back in the late 90s, during the dot-com bubble, really expensive and unprofitable internet stocks were taking over the market, while the Buffett preferred value, safe, and quality stocks were beaten down. So, how did he do it? How did Buffett become among the richest in the world? The answer is that he stuck to a strategy, buying cheap, safe, quality stocks for a long time period, surviving rough periods where others might have been forced into a fire sale or a career shift. And he boosted his returns by using leverage. Okay, maybe you don't have access to a cheap source of leverage or are unable or unwilling to take on that level of risk. Me neither. But factor portfolios are available, and history has shown that targeting those factors has handily beaten the market, at least historically. And if you choose to implement a factor portfolio, it's important to practice ironclad discipline. In fact, this is what the authors of Buffett's Alpha suggest. And in 2 words, brace yourself. Our results suggest that long-term investors might do well to set a realistic performance goal and brace themselves for the tough periods that even Buffett has experienced. That's it for today. Thank you so much for watching. If you enjoyed this video, make sure to like and subscribe, and more importantly, share this video with a friend. Also, make sure to head to alphaarchitect.com/subscribe, and there make sure to subscribe to the blog where you can find more educational resources like this one. Lastly, make sure to follow me on TikTok at Coffee Hour with Jose. I'll see you next time.